Welcome everyone. My name is Nikki Johnston and I'm with Transition Advisors. Our webinar today is Succession Planning Using Sales and Mergers. Before we begin, we need to cover a few important items. First, please close any other programs running on your computer. This will help to ensure quality presentation and reduce any audio issues. Transition Advisors LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. In order for you to receive your 1 CPE credit for today's webinar, you must complete 2 requirements. First, you must participate in 3 out of the 4 polling questions throughout today's presentation. And please note that GoToWebinar does monitor your participation in these polls. Next, you must complete an online evaluation. If you registered for today's webinar through Transition Advisors, you'll receive a link to that survey and an email from me later this afternoon. Once the requirements are met, your CPE certificate will be emailed to you within 10 business days. In order to fully participate in today's webinar, please take just a moment to familiarize yourself with the GoToWebinar control panel. You should see that to the right-hand side of your screen. The orange arrow near the top would minimize the control panel. And during the presentation, all the participants are muted, but you can communicate with us by using the question box toward the bottom of the panel. Just type your question in the box and click send. Questions are important to us, and time permitting, Joel will answer all of your questions during the presentation today. Finally, I'd like to remind you that Transition Advisors offers a free 1-hour CPE webinar each month. Our upcoming topics include internal succession readiness assessments and evaluating accounting firms. We also have region-specific webinars for those of you in the Mid-Atlantic, Midwest, Southwest, and in Florida. You can see the dates and the titles of each of those, as well as our other webinars, and have an opportunity to register for those on the CPE courses section of transitionadvisors.com. Now, before I hand it over to Joel, we'll go ahead and launch the first poll for today. You'll see that on the screen, so take a moment to answer here. The question is, how many partners are in your firm? So options are 1 to 2, 3 to 8, 9 to 20, or 21 plus. And we'll give everyone just another moment here to answer. Okay, it looks like we have nearly everyone in. Joel, 77% of the attendees today have 1 or 2 partners in their firm. Another 15% have 3 to 8. And then 3% at that 9 to 20 mark, and 5% of our attendees are 21 plus. All right, I'll go ahead and hand it over to Joel now. And just a reminder that you did receive a link in the reminder email that you received for today that has a link to the slides that you can download, but I've also just resent that out to you via the chat function. So if you'd like to follow along, you could download it there. Now I'd like to introduce our presenter for today's session. Joel Sinkin is the president of Transition Advisors. Thank you so much and enjoy the webinar.
Thank you, Nikki, and hello, everybody, and welcome to our first session that we're doing since tax season ended. And I've heard all the war stories, and I'm sure you all have a lot more. The topic that we're doing today is really designed for people who are thinking about growing through acquisition or thinking about slowing down. You know, both sides of the spectrum should understand the process of succession planning. We're not going to be focusing on valuing accounting firms today. That's one of our, I think that's our July session. Today's more about the concepts that to think about when to start your succession plan. This is usually a little bit longer of a session, and I'm trying to squeeze it into a 1 CP class. So I'm going to probably be a 33 record on 78, and if you don't know what that means, you probably don't have to worry about succession. Just to give you a quick idea, these are never infomercials for the company. They're for education. But I do think it's important to have an understanding of the speaker's background, so their perspective. Since 1990, the only thing I've done and our company does is help accounting firms buy, sell, merge, mainly growth and succession plans through mergers and acquisitions and readiness assessments. We've been involved in over 800 closings of accounting firms, from some of the largest deals in the country to sole practitioners. Based on the attendance today and they're acknowledging the size of their firms, we'll focus a little bit more on the smaller practice and the big one, but hopefully there'll be value there for everybody. This is just some more propaganda that I'll go through fairly briefly. This is our team. We are pretty much all over the U.S. and in Toronto area. Enough with the propaganda. I always start these classes by reminding people that there's 50 things we need to know, in this case about succession planning. The smartest person in the room is going to get to only about 35. We're not going to get you to 50 today. And the reason for that is the uniqueness of everybody's practice. I could show you 5 practices with the same amount of partner, staff, and revenue, and there may be nothing else in common about them. That said, there's more in common than not. We're going to focus today on trying to get us into those deep 40s to understand at least 45 out of the 50 things we need to know. Let's start with what's going on out there. If you're a reader of the Journal of Accounting, see, for example, in 2013 and 14, we wrote 18 of articles in the 24 months that they published, all about M&A, accounting today, M&A. You're constantly hearing about it. So why is the activity so high? Part of it comes down to timing of the years. 2006 through 8, there was so much organic growth that M&A wasn't as much of a focus. And that time, the greatest problem was staff. The work was there. 2009 to 12, the economy was in a different place, and organic growth was so challenging, and there was so much attrition that M&A started to become more popular again. And here we are in 2015, and we're kind of like in between. Growth has been okay, but not great for a lot of people, but yet the talent is becoming more and more difficult to find. A big push to the M&A activities really comes also from the desire to be involved in niche development. The idea of cross-selling services, where, for example, in the Midwest, we did a deal just a little while ago that closed with a firm that had a whole bunch of law firms as clients who merged with a firm that did a lot of litigation support, expert testimony, business val. We hear about the high net worth individual firm affiliating with the firm that does wealth management. Lots of niches that have caused a lot of mergers. Top 100 firms have been focusing on getting footprints in areas they're not. But by any measure, the greatest reason for the significant activity in the mergers and acquisitions world are the baby boomers. We're facing over the next 7 years the greatest exodus of accounting partner level talent we've ever had, and unfortunately coming at a time where we have perhaps the smallest talent pool we ever had to replace them. And as a result, succession for all or some of the partners has become a driving factor in many mergers that are done today. So just to give you an idea of some of those demographics, we won't get into it too much, but in 1993, just a bit over 40% of our AICPA members were over 40 years old. It was well over 70% in 2012. In the 2012 PCPS Succession Survey, they found that 2/3 of accounting firms stated at least one partner would retire within 5 years. More than 50% of the firms that had more than 3 partners said at least 2 would be slowing down. Yet only a small fraction of the firms even have a succession plan. It's that get around to it when I can get around to it. So today we're going to try and talk about, starting with, when do we get around to it? But what's the good news is that there's still a market for most people who are looking to move their practice, because in our profession, there's really only 3 ways to grow. One is client at a time, which in a good economy works pretty well in a time where we have a lot of attrition from retiring people selling their businesses, passing, moving. It's a little more challenging. Of course, developing a marketable niche to cross-sell additional services to our pre-existing clients is a method of growth. But the fastest and becoming the most popular method is by merging or acquiring another firm. To get this whole thing started, what I want to do is focus, for those who are thinking about their succession plan, of when you should start your succession plan. But in order to think about that, I want to take a step backwards for a moment, and let's all think about why we have our clients. The reality is 99% of accounting firm clients have no idea if their accountant is competent or incompetent. I say that because if they knew that much to measure our technical skills, wouldn't they be doing the work themselves, unless there's an audit involved that they couldn't do themselves. So most of us have clients that are loyal to us because they're comfortable with us. They believe in us. I hear silly things all the time. What a great accountant I have. You should see the refund I get. Well, we all know that's not an answer. Maybe you'll go to jail if you get audited. Maybe the government shouldn't have your money all year interest-free. We know there's a lot of other explanations than that. But this is what we hear. So why do you have your clients? It's you and your team. You're their most trusted business advisor. And this is a very important factor in understanding things, because the greater the partner loyalty that exists between a partner of a firm and their client base, it's a different challenge than brand loyal clients. See, if I'm a partner at PwC and I retire and they slap another partner in, it doesn't usually have a huge impact because that client's a client there because of PwC. At Jane Doe and Company, they're a client because of Jane Doe. So if you're partner loyal, and if you fall into this category, one of the first things I ask you to think about is, how many tax seasons do you want to work full time? Let me share with you why. In 1990, when I first started doing this, a lot of the small firms I worked with, the partners went out every month or quarter to see their clients. Heck, a lot of them did the work there, wrote their check, the client signed it, and they left. But now we're in 2015. If you're not on the cloud, get there. Most people have cloud portals. They're emailing to their clients. They're remotely going right from computer to computer. Staff's picking up the work. But in a recent Accounting Today article, they estimated that 87% of accounting firm clients only are in the same room with their partner that handles them or owner once a year. So if those clients are really loyal to you, and most of them you only see in person once a year, I ask how many more tax seasons you want to work full time, because let's say you said 3 years. Sounds like a long time. It's 3 visits. 5 years or 5 visits. So the frequency that you have FaceTime with your clients is going to have a huge impact on when you can start the transition process. It's very challenging to transition people through the phone and email. Has to be done in person so that that comfort level is created with your successor. So the less frequent you have FaceTime with your clients, the longer in advance you need to start the process of transitioning your practice in order to maximize client retention, which maximizes the value and the win for both the buyer and the seller. Now, it's important for all of you who are closing in on this to start that process sooner than later, because things are changing. Things are changing greatly. You cannot get away from supply and demand. And more practices are starting to look for a succession solution. And each year, based on the demographics of our profession, that number is going to grow geometrically. We have already seen practices come down in value. In July session, we'll talk a lot about it. They're still good value, but not like the old days where you got 1.5 to 2 times. Those things aren't happening anymore. And they're going to continue to go down as more and more practices become available. I get the question asked of me frequently, is it a buyer or seller's marketplace? The answer kind of depends. For example, if I'm a small firm and I'm in a densely populated part of the country, it's very much a seller's marketplace. I live on Long Island. I know my accent fooled you all. You probably thought I was from Atlanta, but I live on Long Island in New York. Nassau County, Long Island has 3,100 accounting firms. If you have a $500,000 practice in Nassau County, there's a plethora of firms that can absorb you with no incremental increases in overhead. It's a very profitable deal. They're going to get a good value. If I'm 3 hours outside of Boise, Idaho, I may be in some of the most beautiful part of the country, but there may be one accountant for every 3 zip codes. So therefore, in those cases, it's a buyer's marketplace. Where the greatest change is happening right now is the $3 to $8 million firm. Look at a place like Boston. Boston's a big city. They probably have 40 firms, or actually a little bit more, doing between 3 and 8 million in the metropolitan area of Boston. There are probably only 4 local firms large enough to take them over. So as these firms start to look for a succession plan, it's not that if you're a $4 million firm, everybody's retiring at the same time, but if you're 4 partners and 2 want to slow down and 2 are young, those 2 don't have the capacity to replace the other 2. They're already working full time. So they have to do a deal. And the larger the firm, the smaller the audience that exists for you. Think of it in simple numbers. There's 45,000 accounting firms as members of the AICPA. You have the top 100, which brings you to about 35 million. You have the G400, which is the next category that brings you approximately to 10 million. Then you have the other 44,500. So you got to think about things a little differently. And starting the process sooner gives you more time to do a proper transition and enables you to get the buyers before they start to shrink even greater. And it enables you to get today's value, which is probably better than the value you're going to see in 2017. When choosing your successor, it's not just how deep their pockets or great their technical skills. Let's assume everybody's going to do good on the payment and knows how to do the work that you do. Why do they want to merge? What's in it for them? That's a question you should ask your successor. Sometimes you get a terrible answer. Well, I have a lot of space, and I'm figured if I brought in another practice, it would lower my overhead. If that's their goal, they should sublet space. This is not a rental agreement. This is a succession plan. So do they have the staff and partner level capacity to replace me? Do they have the space to move me in? Does their technology and my technology make sense? If I'm on the cloud, I'm paperless, I'm 3 screens on a desk, and you're 1 screen and piles of paper and not on the cloud, that's a cultural issue. IT's actually become a cultural thing. Do they have the financial strength? Here I've been involved in, as I said, well over 800 closings of accounting firms, and not one of them have the successor firm not done a due diligence on the firm they merged or acquired. Yet how rarely the seller does a due diligence on the buyer. At least run a credit report. They're robbing from Peter to pay Paul. You don't want to wake up one day being Peter. Right? And keep this in mind. Bigger is not always better. Better is better. Bigger is better most of the time. And most of the time you need somebody bigger than you to take you over. But think of it this way. If I'm a small $300,000, $400,000, $500,000, $600,000 compilation tax-oriented practice, what's my main job? Hand-holding. Is a partner at a $15 million firm going to hand-hold a $5,000 a year quarterly client? Probably not. So when I say bigger isn't always better, as a $500,000 practice, I might have to go to a $1 to $3 million firm, and volume's not always a proxy for culture, but so don't get hung up on it. But it's highly unlikely that my client fees, my relationships, and everything in a small firm is going to make sense to a top 100 firm. So you need to think about your successor that way. Do they have the specialties that you have? I'll give you an exaggerated but true example. In the state of New Jersey, to do municipal accounting work, you must be an RMA, a registered municipalities accountant. It's a separate exam you have to take. If that's my niche, I got to make sure the successor has it. Do they have the capacity? Does our fees make sense on our rates? Does their location make sense? I get asked a lot how location sensitive are accounting firms. It really depends. The more people that come to your office, the more geographically sensitive you are. If you're going out to see the clients, they're mailing it in, they're on portals, things like that, then the location is only relevant to your staff, which is important, and your partners. But location is sometimes overrated. But the big thing in selecting a successor, and we'll talk about it more lately, is culture. For example, if I have partner loyal clients versus brand loyal, it's very hard to mix certain cultures. Like if we're a 3-partner firm, we each have our own book of business and it's an eat what you kill environment, hard to bring that into a one-firm concept. So there are certain cultures that don't mix as well. Sometimes it's dress code. I've had people that walk around wearing jeans and a shirt and they can't sell it to someone who walks around wearing a suit and tie and vice versa. Culture is what's important to your culture isn't necessarily important to others, but it's important to your successor and you share a culture that makes sense. Like, do they have the strength in staffing? I like firms that have partners that have been together for a while. Sometimes when partners first get together, it's a little bit more challenging. So there's a comfort in that. It doesn't mean I wouldn't do a deal with people that are brand new partners. It's just a red flag. And we're all so busy being politically correct, we forget that there's certain practices that have ethnicity and language considerations that are realistic. I had a seller in Astoria, Queens. If you didn't speak Greek, you couldn't buy the practice. Throw me in a politically incorrect jail, but that's the way it is. So sometimes we have to face reality. In Texas, we had a firm owned by women. Their marketing campaign was women-owned accounting firm helping women-owned businesses. Well, you couldn't sell that to a firm filled with testosterone. You needed some estrogen. It's the reality of where you are, and we have to think about these types of things. Some people think I'm attempting humor at this slide, which I am definitely not. I also think it's really important to understand what a lot of sellers are thinking, which is part of the reason that some of them are putting it off. They think I'm irreplaceable. My clients need me. If I retire, I'll die. And a lot of them, they've been on their own for 20, 30 years. They're master of their own domain. The idea of affiliating with someone who's going to be taking them over and having additional accountability is very scary. You want to respect these things. You want to go into that understanding that this is much more of an emotional decision than it is financial. Nobody's going to buy your business to lose money. So the key is finding that the seller should get paid for the years of equity, sweat equity, and the buyer should make a profit. That's not the brain surgery part of it. It's the emotional side, the cultural side, how to do the transition. That's where success and failure always lie. And by the way, I was teaching a class for an accounting association very, very recently. It was less than 3 weeks ago. And I was talking about this very particular specific subject. And a gentleman raised his hand and said, no, nobody could keep my clients if I'm not there. And I said to him, then your practice is worthless. And he got very annoyed with me. He said, no, that's how great my practice is. I said, no, if you're telling me that nobody can keep your clients, why would I buy your practice? It's counterintuitive, but the greater the loyalty between an accounting firm and their client, the easier it is to transition, as we'll discuss at the latter part of today's session. We have our second polling question, Nikki. We want to make sure everybody gets their CPEs. Can you jump on that?
Sure. Our second polling question today is, which of these best describes your firm? Your options are looking to grow, considering near or long-term succession, or staying the same. We'll give everyone just about 30 seconds, so take a moment here to select the one that best describes your firm.
If you're stuck listening to me, you might as well get your CPE out of it, everyone.
Okay, Joel, we've got nearly everyone who has answered, and we've got a pretty even split. 39% say looking to grow, 33% considering near or long-term succession, and then 27% staying the same.
Wonderful. So we have some people who are just curious to what it's about, and some people in need of one side or the other. All good, and fairly typical of these types of classes. Now, once we've decided to look into a succession plan, there are really 5 main structures I've seen that most of the deals we consult and work on fall into. The first category is called a straight sale. Now, this doesn't mean I'm selling my practice and going to Boca or Phoenix tomorrow. What I'm referring to there is I'm not looking to be an equity owner. I'm not looking to stay on full-time. I might and probably desire a part-time role, and hopefully I'm available to do a proper transition, but I'm leaving full-time and equity behind. Let's call that a straight sale. Probably the least often deal I've been involved in, but I've seen occasionally, is what's called a buy-in to a buyout. Let's say that I have an $800,000 practice and Gretchen has a $200,000 firm. Well, the new practice is $1 million. For Gretchen to have been an equal partner, she needed $500,000. She only had $200,000. So she acquires $300,000 in revenue from me. Now she's a 50% partner. And 3 years later, I go to retire, she buys out the balance. I've seen a buy-in to a buyout also where the buyer's practice was kept out of the equation. So, for example, in that situation where I was $800,000, maybe I don't want to have anything to do with Gretchen's $200,000. So she buys $400,000 into my firm. We're 50-50 in my firm. Then she buys me out, but her business is kept separate. A merger to a buyout is a very similar concept to a buy-in to a buyout without the buy-in. So if we use the same example, perhaps I'm 800, Gretchen's 200. We merge together. She's a 20% equity partner. I'm an 80% equity partner. And when I retire, she's buying out my 80% interest. A merger to a buyout. What's coming up more often than it used to be, but not my most often, but probably I guess the third most often, are these cull-out sales. There's 3 types of cull-out sales that we're involved in, and we're involved in all three every year. That's how often I'm seeing them. The first one is what's called a niche call-out. There's two examples I can give you right off the bat. Just last year in the Philadelphia area, we had a firm that was doing a great job with asset management and loved the wealth management side, hated the compliance side. But the compliance side was his springboard to getting the wealth management. He felt stuck with it until he actually read a book that my partner and I wrote for the AICPA, and he called us up and he said, look, I'd love to talk about this call-out sale. What we did was we introduced him to a local firm that wasn't doing wealth management. He sold them the compliance, traditional work, accounting and tax work to that firm. He signed a non-compete in doing traditional accounting work. He retained his wealth management and worked out an agreement with the buyer that they would expose his wealth management services to their clients and set up a kind of an incentive program between everybody. To the world, it was held out as a merger, where the announcement letter that we helped them draft basically said, hey, nobody can stay on top of the day-to-day changes in the stock markets and all your investment portfolio and the constant updating of tax regulations and things like that. So we've merged together, and I'm going to focus on this, and they're going to focus on that. We're going to operate under the same fees. It was a very compelling situation that used the age of specialization. Everybody kind of got what they wanted out of that. Another type might be the opposite, where we had a firm that had a niche that did litigation support, expert testimony, forensic accounting, business vow in a larger firm that they decided they were no longer wanted to be in that field, and they culled it out and sold that and kept the traditional stuff. So it could have worked either way. One type of call-out sale. Another type that happens even more often is, I'll give you another specific example. In Florida last year, we had a small firm. They were doing about $950,000. One of the gentlemen who was the main owner had about $150,000 of clients that he had a very strong personal affinity to. They weren't his best paying clients. Matter of fact, they were some of his worst paying clients because they were some of his oldest clients. But he had a special relationship with them, and he wanted to stay busy. He sold $800,000 of his accounting firm, and signed a non-compete except for the clients on Exhibit B, the $150,000 that he kept. He actually even worked out a deal with his buyer that they gave him free rent, free use of their office, software, everything, other than any incremental increases in overhead, to run his $150,000 from. They did that because now he was there to be the glue to cement the relationship on the $800,000 that they acquired. They had first right of refusal to buy the last $150,000 at a later date. It was a home run for everybody. So that was a cull-out sale where they kept some things to keep them busy. And for this gentleman, his gross became his net practically on the $150,000. At his purchase price, he almost made the same money working a couple days a month that he was making when he was working 50-hour weeks. The last cull-out sale I've had to do for some large firms who had succession issues. There was a firm, for example, in the West Coast that we did an internal succession readiness assessment for. And the problem was pretty straightforward. They lack the capacity to replace the 6 of the 11 partners that were leaving. And they absolutely refused to think about an upstream merger, which was their mistake. That was the right solution for them. But after 3 years of attempting to develop talent and merge in talent and failing, they've called me up and said, we still can't get it done. What can we do? We won't merge up. Well, we used the old rule of thumb. On there, I think there were about 10, 11 million actually. The 10, 20% of their lowest paying clients took up 40 to 50% of their time. We took $1.5 million of their lowest paying clients. We brought it to a firm that was smaller. The big firm's basement was pretty much the ceiling of the smaller firm. And they said to all those clients, because of our quality control process and peer review requirements and PCAOB and blah, 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 we're going to have to give you a substantial fee increase. However, instead of doing that, we've affiliated with a firm that we're going to have a relationship with, that you're going to be able to be serviced the same way with the same fees, no fee increase. Whatever the clients chose, the firm won. If they sold the client, they made more money selling it than keeping it. If the client stayed and paid more, they could afford to hire better staff, but that wasn't the case. Most instances, and those who left, left. But that was a cull-out sale. But by far and away, the most often deal that we see is a two-stage deal. Let's understand that a two-stage deal was designed out of failure of 15 years of my experience trying to get people to do the deal. I'd go around the country teaching, especially on behalf of the AICPA, saying, why do you have your clients? It's because of you, and 4 years is 4 visits. You got to get out. You got to start it soon. Everybody said yes, and nobody did it. Well, a smart person would have figured it out in weeks or months, but 10, 15 years later, the reason that I finally established that people weren't doing it was accountability, master of their own domain. The idea of merging my last 2, 3, 4 years of working full-time with somebody else that I'm going to be accountable to is so distasteful, I'd rather not do it, and I'll keep putting off my succession. Hence the two-stage deal. The two-stage deal was a deal created to give the seller the opportunity to do a proper transition over a series of years without yielding control or income. So let's take a look at how a two-stage deal works. Let's start with stage one. In order to start, we're going to take the seller's practice. We're going to say, okay, how much revenue do you do? How much labor do you use outside of your own labor to achieve the net that you make on that gross? So let's take a simple example. Use a small one. Let's say we're a $500,000 firm. We have 2,500 hours of professional time, 2,000 hours of clerical, paraprofessional time, and the partner does the rest. And let's say their net is 40%. And I'm saying net, including perks, benefits, the kid's cell phone, whatever their net is. And let's say that I wanted to work 3 more years full-time, maybe 6 more years after that part-time, but 3 more years full-time. All right, we've established the foundation of what I'm looking to do. I want to make the same money. If I put in the same time and effort, my revenues stay there. I want to transition relationships, but I want to stay in control of my business. The next step is I go in with a firm that I'm comfortable with, and they say, Joel, right now you're making 40% of what comes in based on using that much labor. We're going to supply you with the same amount of labor, and we're going to pay your entity 40% of what comes in. And the reason I say pay the entity is a lot of times the smaller firm may be more aggressive in what they run through their entity. Maybe they have certain items in addition to the car lease, but now they can do what they see fit. So their original entity continues to feed retirement plans, pay the car insurance and the life insurance and the medical insurance, all these things. And they pay it with just as they have done in the past. So now, as the buyer, I get a current deduction, and as the seller, I'm still getting the use of pre-tax dollars to deduct off of that. Notice I spent my time on the small deals talking about how much labor the seller used, not how much labor the seller did. And I'll tell you why. In a small deal, it's irrelevant. You see, if the seller had 2,500 hours of professional time and 2,000 hours of para/clerical time, and the seller put in 2,000 hours of their own time, let's say that the seller still put in 2,000 hours of their own time, but I needed more professional time. It would cost me as a firm money. See, what matters to me is what I have to pay as the successor firm. So if the seller puts in 1,000 hours or 2,000 hours, that doesn't impact me. What impacts me is how much labor I have to do. So if I'm going to take over all the overhead and everything, I'm going to focus on providing the seller the same amount of labor support on the same level they used in the past. If they need more than that, I'm going to charge them for it, just as if they didn't do this deal and needed more labor, they'd have had to pay for it, no different. But we're going to be able to provide that to them. Now, from the seller's perspective, the deal, usually day one, the successor firm takes over a lot of the billings, collections, IT, because they're going to administer the practice. So I actually technically probably get to work a little bit less, and I'm making the same money. Usually the successor firm, we're billing it under their name, so we're getting the clients acclimated to this firm. We're holding it out as a merger, obviously. So in a way, this is like a practice continuation agreement for a seller, but on steroids. See, a practice continuation agreement, by definition, it gets enacted if a seller is disabled or dead. There is no transition. It's a search and destroy mission. I've got to go in there and figure out what's going on, pick up the pieces. And, of course, nobody gets disabled in November. Everybody gets disabled in February, March, and April. So it's a nightmare. But this is like a PCA agreement because if something happens to me, I'm already there with the firm. I already have all their records. They're already on their system. I also get free backup and support, not more labor than I used before, but more people to bounce ideas off. I list on the slide here that it mitigates the loss of a client. Let me tell you why. Let's say that I had a $10,000 a year client, and last year it went out of business. I'll probably lose $10,000 of personal income. All my other expenses were fixed. But now in a two-stage deal, I'm making 40% of what comes in. I lose a $10,000 client, I lose $4,000. I don't lose $10,000. So my downside is capped a little bit. And by doing this great transition, I'm getting the clients more slowly acclimated to my successor, which means higher retention. And since most deals have a retention element where the seller's paid tied into retention, seller makes more money. So there's huge benefits to the seller. Why would the buyer do it? Well, in this example, where I said 2,500 hours of labor, maybe the buyer had enough excess capacity to replace the clerical completely and maybe enough to replace a lot of the per diem that they had. Maybe they only keep the senior. If I have the space to move them in as well, on a $500,000 practice, between saving on the clerical, if I had the capacity, saving on the rent, saving on the software, saving a little bit on malpractice insurance, I could put $100,000 in my pocket on overhead synergies before I even take over the practice. Sometimes that happens, and the seller calls me up and says, you know, they're making $100,000 in overhead redundancies. I should get some of that. And I yell at them, no, you shouldn't. You got everything you wanted: autonomy, control, income, backup, support, and succession. The fact they're getting a benefit's why their buyer's doing the deal. Don't take away their motivation. They're taking over the billings, collections, administration. You, in a two-stage deal, even though you're held out as a partner, you should never want equity. Therefore, you don't even have liability. They do. It's their neck. Of course they should be compensated for it. So a two-stage deal keeps the seller whole in income during stage one, does a great transition, gives the buyer overhead synergies, cross-selling opportunities, and hopefully great client retention. In a large firm, where let's say it's 6 partners and 1 or 2 are going into a two-stage deal, instead of it being based on labor, we'll usually then base it on the sellers maintaining their chargeable hours. Not their gross hours, because some of that's going to go away. So in a two-stage deal, you got to always know at the very beginning when does stage 1 end and stage 2 begin. It's usually with some back date, or God forbid there's a health issue that comes up. God forbid a health issue comes up, you accelerate to stage 2. Right? Usually we don't, if there's a retention period involved, as there is in most deals, keep in mind the retention period doesn't start till stage 2. During stage 1, the seller's still in control. And usually if the seller's going to stay on once the buyout starts, we have to work out a compensation system. I'll go into the greater detail in the subsequent classes about that, but off the top, most of those times I pay the seller a third of what they're billed out for, because that's what I'm trying to do as an accounting firm, triple labor. I'll also give the seller a new business incentive program. If they bring in new clients, I'll give them something else. And of course, up front, we're going to have a buyout formula, not a price. It's usually a formula of what we're going to pay based over what period of time, based on what multiple, based on what level of retention. And again, tune in July if you'd like to hear real details on what is that multiple. So that's a two-stage deal. Once you understand all these different types of deal structures, it gives you a lot of power to do things you wouldn't have normally thought to do. For example, right now, in the D.C. area, we're working with a $4 million firm. They have 5 partners. One already said that was my last tax season last year. The second one, the next 2, one wants to work 3 more years full-time, then slow down. The other 5 more years, and then slow down. The remaining partners are all under 50 years old. But they lack the capacity and skill set to replace all the partners looking to slow down. We took them into one firm. In that one firm, we created 3 different deals for each partner's interest. Partner looking to slow down quickly, we gave an immediate sale to and enough counsel role. We're starting his buyout right away. The 2 that are 3 to 5 years away, we're doing a 2-stage deal for. The remaining partners that are young, we're doing a merger with, where they're exchanging equity in their firm for equity in the combined firm. This is a very typical thing in multi-partner firms. It's very rare you have a multi-partner firm where everybody is at the same place in their career at the same time. So understanding these different deal structures enables you to work things out in that way where you can customize the deal for each partner and not have to have everybody tied down to the same deal. Now, the partners that are staying on in a merger, they've got to be the biggest decision makers because they're the ones who have to live with these people longer. So make sure you learn things. What does equity mean? I've had many firms fight over equity, and then you read their partnership agreement, and it's one person, one vote. Profit is based on formulas, not equity, and your buyout's based on a multiple of compensation, which it wasn't based on equity. Other firms, equity means everything. It's my voting power, it's my profit distribution, I get a buyout on a multiple times my equity interest. So those staying on have to think a lot differently. They have to think about, what does equity mean? Is there retention that impacts, or once I'm in, it's all one firm? How does compensation change? How does the role work? What about my buyout? What about that firm? How many other people are retiring? Can we replace everybody, including my two partners? So there's a lot of things that go into this. When you're teaching a 50, 55-minute one CPE class, you can scratch the surface. But these are really great things to keep in mind so that you understand that you can be creative and not have to fight to get everybody on the same page. You don't all have to be, except for choosing the successor that everybody feels comfortable with. A couple other things to think about. A lot of times people will ask me, well, what about all my furniture, fixtures, and equipment? My answer is, never ask me that again. It's worthless. Throw it the hell out. Make a donation. Unless it's a merger with a satellite office, small firms rarely place any value on hard furniture, fixtures, and equipment. Big firms do, but big firms pay lower multiples too. When figuring out what retention means in your deal for your purchase price, you got to decide: are we going to count fee increases that the clients get because of the successor firm, based on prior services, based on new services? By the way, the answer most of the time to me is yes. It's very hard to negotiate a deal with the seller that says, hey, if this client went out of business and I lost them, I don't have to pay you anymore. Oh, by the way, if I was able to bring this review to an audit and move the fee from 15 to 25, you're not going to get that either. A good deal is a fair deal. If you're paying the seller more than you thought you would be, you're making more than you thought you would. Let it go. But usually where you don't have to share with the seller is on fee increases from referrals. Unless the seller gets the referral, which would fall into a new business incentive clause, the referrals is the fruit of the successor firm's labor. We've got another one for you, Nikki. Polling question number 3, our second to last one.
Okay, here's the third polling question. Your most likely succession plan looks like, and your options are selling internally to my partners or staff, finding an external buyer, or no idea. Again, we'll give everyone just about 30 seconds to select their answer. And Joel, I've shared the results there. It looks like, again, a fairly even split. 24% selected the first one, selling internally. 36% said find an external buyer, with the remaining 40% indicating that they're not sure.
Thank you so much, Nikki. Everybody keep in mind, for those who brought up the internal succession, they would teach in another class. It's free, so it's not like we're trying to solicit revenue here, on internal succession readiness. But here's what I wanted to share with you. Be careful when you're counting on that. You have to make sure that below you are people that have the skill set to replace you. Not just the technical skill, but the people skills that retains the clients, the trusted advisor skill, the management skill, the rainmaking skill. And if your succession plan is based on the idea that I'm going to find young talent, bring them in, and groom them to be my successor, I don't mean this as harsh as it sounds, but that's a pipe dream. That's no longer a succession plan. The greatest commodity in public accounting is young talent with a book of business. Second greatest commodity is young talent. And the firms that are larger than your small firms are willing to open up their pocketbooks deep and wide because they have the same succession issues you do, but multiplied. And they have deeper pockets to bring in that talent. So internal is a great way to go. Just be realistic that you have the strength on the bench to accomplish that. Now, obviously, before anybody does a deal, there's going to be some due diligence. I'm not going to invest a lot of time into the due diligence concept. But what I can tell you is there's a couple things that are more important to look at than most people realize. Everybody's focused so much on billing versus collections, which is important. But there's a lot of things that you have to understand better. For example, if I'm selling someone my firm, I want to know their retention rate. If they can't retain their own clients, why would I think they're going to retain mine? I wrote an article once called The Great Mystery of Billing Rates. And I talk about this when I talk about due diligence. And what I try and teach people is that the seller's billing rates and profitability may have nothing to do with the successor firm. Let's talk about why I say that. Right? Let's take a simple example. Let's say there was I'll use a specific example. In New York, 2 years ago, I had a $1 million firm, $1 million, owned by two partners. They had two partners and no other professional staff. Everybody else was paraprofessionals. Very unusual, but these two did all the heavy lifting. When it came to due diligence, the buyer called me up and said, Joel, we should have known this day one, but we got a problem. I said, what's the problem? He said, they're only getting $225 an hour. In our firm, we get $350 an hour for partner time. I asked him a question. I said, in your firm, not who's going to hold the client's hands, but who's going to do the work? You just did due diligence. What kind of work level for your firm would that be? He goes, it's almost all senior work. I said, what's your senior billing rate? He said, $150. I said, I guess they're getting $225 now. See, it's not what their billing rate is. It's what the successor firm's rate's going to be. If I'm going to be able to leverage the work down because I have a deeper bench, if I have better technology, I might be able to take less time and effort from a lower level staff to generate the same fee. It could be the opposite too. I've had small firms whose quality control process wasn't as robust as the large firm, and the large firm was going to have to put more time and effort to derive the same fee, in which case the rate would go down. But when you see someone's billing rate, that's a starting point, not an ending point. Same in profitability of the firm. I'll give you a simple example of that. Let's say that 5 years ago I had a small $300,000 practice. I ran out of my home. My wife, Kathy, answered the phone. What was my net? 85%? But then we were tired of people knocking on the door. I took an office. She didn't come with me. I hired an office manager. Wanted to work a little less. I hired a per diem guy, and now I'm netting 40%. At which point in time was my practice worth more to you? It's irrelevant. If you could absorb my practice with no incremental increases in overhead, it's a very profitable acquisition. If I say to you, you've got to pay me over 5 years, but I want goodwill, and you have to deduct it over 15. You got to keep my location. You got to keep my office manager. She makes $150,000 a year and has 16 weeks paid vacation, but she's been with me forever. It's not the seller's profitability, it's the successor firm. Same with billing rates. So you can see there's a list here of due diligence. It's important, and everybody has access to this. Plus, I've attached a whole bunch of articles. One of the articles I've attached that you have access to is in a whole article on due diligence. Matter of fact, on our website, under the resource section at transitionadvisors.com, there's a resource section. You don't have to sign in or anything. There's probably 80 articles we've written on all different subjects that will help you, and due diligence is certainly one of them. So you need to get your due diligence and go through the whole thing and understand how you're going to run the practice as the successor firm. But what I want to finish with, technically we're almost out of time now. It's supposed to be 2:50, but I'm going to drag you a little deeper, is the thought process you should have in choosing your successor. We talked about when to start. We talked about a lot of things, but I think it's really important that we re-speak about the 4 C's. If there's one takeaway I suggest you all have today, it's the following. If you don't want to eat lunch with someone, don't do a deal with them. Chemistry, 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 chemistry. We just went through the fact that most of you on this phone are partner loyal firms. If your clients are comfortable with you and your staff is comfortable with you and you're not comfortable with me, why would you think your staff and clients will be? There is nothing close to being as important as chemistry. The next thing is culture. We've spoken a little about culture. Could be dress codes, could be the way people are billed, it could be so many different things, where they're serviced, how they're serviced. Identify the culture that is important in your mind and make sure that that culture is within reach of the other firm without getting silly about things. You don't want to have, well, we wear, polo shirts every Friday. They should do the same. Let's be careful about what level we go. I think the two things that people don't think enough about of the two C's are capacity and continuity. Let's start with capacity. For example, I got a call last week from a firm in New Jersey telling me that they're a two-partner firm. One partner is looking to slow down, the other is young, and they're talking with a firm of equal size in the same position about merging. And I said to them, okay, so you're now each two partners where one's going to retire. Now you're going to be four partners where two's going to retire. Did you just help your succession issues or double them? Why? Because they didn't have the capacity to replace them. So if I'm doing a merger for succession, if that's my goal, I have to make sure that the successor firm has the capacity and skill set to replace me. Now, it may be spread around multiple partners. It may be done all differently. But I've got to make sure that capacity issue is there. Because if that firm says to you, don't worry, you're going to be here 3 years, I'll hire someone during those 3 years, too risky. They've got to be able to have a plan that you could buy into based on their current bench strength. And remember, a lot of firms who have partners that are retiring have key staff that are retiring that have been with them for 20, 30, 40 years. So you might be replacing a partner or two. You might also be replacing a senior and a manager or two. They've got to have the capacity. And the last C is continuity. People like the way you're sailing your ship. If someone's going to change that direction, it's a problem. And we're going to talk more about that in a minute. Now, also remember, when you're putting together a deal, it's a package. Try not to negotiate one thing at a time. You can't negotiate the multiple if you don't know the payout period, the tax ramifications, the retention period. Is there money up front? How are we treating AR and WIP? It's not brain surgery, but there's a voluminous amount of aspects to these deals. And when you try and negotiate one deal at one aspect at a time, it's death to the deal. You got to put the package out there, and it's got to be a fair package. And a seller has to remember, I spoke to a seller the other day, called me up, and he told me the terms he was looking for his firm in Atlanta. And I said to him, have you ever helped anybody of your clients buy a business? And he said to me, son, I've helped hundreds of people make a decision about buying a business. I said, well, did you ever tell them, buy this business, you're going to lose money for 5 years, it's a great deal? He said, of course not. I said, so why are you telling me that? The terms you're telling me, nobody's going to make a profit. He goes, well, but at the end of the 5 years, they have my whole firm. I said, they could be dead in 5 years. You just told me you never told one of your clients to do that. Why should I tell one of mine? So the seller needs to be paid for their years of sweat equity. They have a great value in their firm, but the buyer has to make something on it. But if the greatest measure of success of any deal is client retention, if the clients are retained, the seller gets the maximum value, the buyer gets the maximum value, and this is the key to success of a deal. So we have to think about, in the transition, what are we going to do? How are we going to send a message that retains the clients? I want to start that by talking about the 4 fears. Not every firm has all 4, but there are 4 main fears a client has when they hear about a quote-unquote merger. First one is the person I trust still there? The second one is this going to cost me more money? Not every firm is very location sensitive, but some are. Am I now going to have to go to Virginia on the Beltway when I was going to Bethesda? And some people are very married to staff. I'm an example of that. The accounting firm that we work with, even though half my partners and everybody at CPAs, we work with an external firm, but their managers, it knows more about our day-to-day business than a partner. I'd be very loyal to that manager being part of a process. These are your 4 fears or maximum. Your job is to overcome them before they're even raised. So let's use the example of an announcement letter as a tool for doing that. If I'm the seller, I'd break my clients down into categories: manufacturing, wholesale, retail, doctors, whatever. Let's say the first group's doctors, and let's use the announcement letter as an example. I might send a letter out to the doctor, and let's say I did a deal with Nikki Johnston. I'm going to send out the letter, and it's going to go in the seller's envelope with the buyer's stationery inside, because if it goes in the buyer's envelope, people may think it's a solicitation and not open it. Lesson 1992. At any rate, here's what the letter might say. Dr. Jones, I'm pleased to announce I've merged with Nikki Johnston. Nikki's an expert in the Obama tax laws and the new Obamacare, especially as it comes to working on different aspects of your tax liability as a medical. So I'm still going to be the partner in charge of you as a firm, but I'll have Nikki's support to provide you even more services. But we will be operating under the same fee structure. We remain geographically sensibly located here in Kansas City, and the same staff you're used to dealing with are part of our new combined dedicated team of professionals. Doctor gets a letter. I'm still there. The fee's the same. I have an expert in their industry working with us. We're in the same place, and we have the same staff. Why would I lose them? The greater the loyalty, the easier it is to retain them if we do it right. We hold it out as a merger. It's not the loss of me. It's the gain of Nikki. And that first month we go out together, and I introduce them, and we start to get Nikki involved in the practice. In a two-stage deal, I have some more time to do it, which is fabulous. But not everybody gets an announcement letter, right? Who gets a letter? Who gets a phone call? Who gets a visit? You don't send a letter to your biggest clients, nor do you go there alone. Another hard lesson I learned in early 90s. Had a gentleman went out to his biggest client, told him how he just merged with this firm and how great it was and everything. And the gentleman said to the accountant, "That's great, Murray, but you're the only one who deals with me." Ever since then, I had learned the seller goes out with one of the partners. Because if you go out with one of the partners, this client's not going to say, "Hey, Mike, nice to meet you. Never want to see your bud here again." You don't empower the client to be the decision maker. You lead them. So who gets a phone call? Who gets a letter? Who gets a visit? What does the letter say? When do they get a letter? If I close a deal July 1st and there's certain clients that I only deal with during tax season, do I send them a letter in July and give them a year to think about it, or do I send them a letter in the tax organizer in January? Lots of different plans, lots of different ways to do it. But what you have to do is de-emphasize change. There's additions, there's not losses. And there's definitely ways to do that. And I want you to think about change in two categories. Change in front of the door and change behind the door. And change in behind the door, for example, is you were using Lacert, I'm using ProSystems FX. Your staff may care, but none of your clients care. They don't know. That's a change behind the door. You don't have to worry too much about too many changes behind the door. A change in front of the door is, I used to go out quarterly to meet this client in person. Now you got to go on the portal, and nobody's going to visit you. And once a year, you can come into our office, and we'll shake hands and kiss babies. That's a change in front of the door. I was charging you $10,000 a year. Now I'm charging you $15,000 a year. That's a change in front of the door. You want to limit and gradually make changes in front of the door. And if you're dealing with a firm that has to make wholesale changes in front of the door, that's a firm you shouldn't do the deal with. Changes have to be done gradually. They have to be implemented. They have to be justified. And you have to believe in that they can be done. So start your succession plan earlier than most people are. Think about continuity. Think about all those things. These are the last and most important decisions you make relating to your practice. Try not to be one of those people that call me in June and say, that was my last tax season. It's great for business, not great for client retention. We have one more polling question to make sure you all get paid. Nikki, you want to finish this up here?
Sure. Our fourth and final polling question is on your screen now. This question is, which best describes your personal situation over the next 5 years? Your options, as you can see, are that you're seeking to reduce your time commitment to the practice, you have partners that are seeking to reduce their role, you're interested in acquiring a firm, or none of the above.
And as you're putting that all together, everybody, keep in mind, because I did what I always do and had run on mouth, anybody who sent in a question that I didn't have a chance to respond to, before the weekend, I will send you that response. by email. Also, sometimes someone listens to this presentation and tomorrow has a question. Don't hesitate. Reach out to us. We'll get you that answer. Nikki, do we have our results yet?
We do. The results are 29% say that they're seeking to reduce their time commitment, 46% none of the above, and then a pretty even split between partners seeking to reduce and interested in acquiring.
Okay, thank you so much. Well, thank you, everybody. On the last slide here is the email address if you had some questions that you were looking to get answered that we didn't address. And also the website. Keep in mind under the resource section, as I mentioned, there's case studies, articles, all sorts of information. It's all free. Dig in. Let's try and make sure that everybody's making informed decisions out there. Nikki, thank you very much.
Great. Thanks so much, Joel. And again, if you registered through Transition Advisors, you'll receive an email later this afternoon from me with a link to the survey. The survey is the second component to get your CPE credit, and then you'll receive your certificate within 10 days. Thanks, everyone, for attending.